Welcome everyone to the California MBA Mortgage Quality and Compliance webinar for this April 23rd in 2020. This is Susan Milazzo with the California MBA, and I'm happy that you could join us today. During this time of lockdown from COVID-19, I think we are all doing a lot more education and networking via with these webinars and information sharing. This is, of course, a monthly compliance webinar that we offer, and we're happy that we already had this, up and running. It's a way to continue to provide good quality content to the industry. If you are joining and you've had the invitation to join forwarded by a colleague in the industry and you would like to be added to our distribution list, please go ahead and contact me, and I'd be happy to add you to our list. My email is susan@cmba.com. I want to go ahead and get us started with our legislative update from our lobbyist, Pat Zenzala. Before I turn it over to Pat, I just have to note that, advocacy is the number one thing that we do in representing the mortgage real estate finance industry in California. And all of the time I can sing the praises of my lobbying team, but in particular in times like this, when we are dealing with extraordinary circumstances and information is not easily, we're outside of our normal channels to follow and monitor information and network with our colleagues in the financial services industry. And I have to say, Pat has done an extraordinary job following what's happening in the California legislature, continuing to leverage our advocacy efforts with others in the financial services sector. And we're just very, very grateful to have him on our team. So I asked, typically, if you join us on a monthly basis, Pat will run through, 2 or 3 or 4 of the top bills that we are following, and he will talk about that. But today's presentation, I just asked him to kind of just give a narrative of what's happening in the California State Legislature, and we're currently out of session due to COVID-19, but there's plans of return and kind of how that looks and what will be priority issues for the mortgage industry. So with that, Pat, I'll turn it over to you.
Thank you, Susan. We're definitely in different times with the COVID crisis as far as the legislature. They have been officially not meeting since middle, basically, of March, and they're scheduled to come back on May 4th. I think at this point, the Assembly is definitely expecting to come back May 4th. We've not received clear communication as to whether the state Senate will come back at that same time. Basically, we would be normally in the middle of policy committees with over 2,000 bills being heard, over the last few weeks into May. The legislative staff and members are still working on their issues, so we have been involved from that perspective. What I think is going to happen is we'll see a reduction of volume. Many of the bills will not move forward, but we will likely see several significant issues of interest to the California MBA be in play. I'll give you 2 examples. One bill that was recently amended, AB 828, is directed at trying to deal with the COVID crisis. It would create a moratorium on judicial, non-judicial foreclosures that occur while there's a state of emergency in place, either put in place by local government or by the state, and continuing to 15 days past the ending of the state of emergency. We have some concerns regarding some of the provisions in that with respect to the foreclosure moratorium. It also would put in place some directives as far as court action with respect to residential evictions that are essentially started with the filing of unlawful detainer actions. So, and there's some very strong concerns with respect to those provisions, especially with some of our allies, the Apartment Association, CAR, the realtors, et cetera, and we have concerns from a commercial perspective. The other issue that I want to mention that will potentially be in play is the governor's budget trailer bill proposal to reorganize the Department of Business Oversight, basically to create a mini CFPB at the California level. It is part of the budget plan, and as you could expect, the California budget, as far as the fiscal expectations, as far as revenue coming in, have been severely impacted. We're uncertain what will move forward and what will not move forward, but in a recent budget committee hearing, Department of Finance representative said that this proposal is still a priority of the governor and has the potential to move forward. We likely will not know definitively in June when the budget is, the initial budget is agreed to, because that's going to be a workload budget, basically just maintaining existing critical services. But we're likely to see a review of budget issues in August after the state taxes are all filed after by July 15th. So that issue will likely, if it is not in the June budget, will likely come up in August. And then we're obviously looking at other issues, but I think those are the two primary issues I want to mention, Susan, as far as of interest to California MBA members. Thank you.
Right. Thanks, Pat. We appreciate that. I think that, at the beginning of the year, we were really thinking that, of course, the reorganization for the Department of Business Oversight, we would, this would be the time when we'd be seeing kind of more details on that plan. And of course, due to the pandemic, we haven't received much more information. But obviously, that's something that we are monitoring very closely and will be a part of, the discussions as they move forward as to, how that whole plan is shaping up. And so thank you, Pat, for your presentation and for all your great work that you're doing on behalf of the industry. We appreciate it. Okay, and with that, I will turn it over to Michael Pfeiffer. Michael is our general counsel, and he will be giving our litigation update. Michael, I'm on your first slide.
Thank you, Susan. Is that the title slide or the one after
the title? The title slide.
Okay. Good morning, everyone. I'm struggling a little bit because I've lost my internet connection here at my office, and trying to figure out what's going on. So I'm on a cell phone. I apologize for that. And Susan's going to be advancing the slides for me. But I wanted to give you a presentation briefly this morning on just a couple of issues that are going on at the federal level. A lot of you, I'm sure, are dealing with these issues because I'm getting all kinds of calls from clients with questions about primarily about the CARES Act and about the interpretations of the CARES Act. And as you know, if you want to go to the first slide after the title slide, Susan, as you know, the act was passed on March 28th or signed into law on Friday, March 28th, and it has a number of key provisions. And I think most of our members are dealing with those. The ones that are of the most importance to us are sections 4021 through 4024, have to do with essentially loan servicing. 4221, deals with credit reporting protection. 4022 contains a 60-day forbearance, foreclosure moratorium and forbearance protections for up to 1 year in 180-day increments for what are known as federally backed mortgage loans. Section 4023 has forbearance protections for up to 90 days in 30-day increments for federally backed mortgage loans on multifamily properties, and it also contains some tenant protections against eviction for on properties where the loan on it is a federally backed mortgage loan, federally backed mortgage loan. And then finally, 4024 is a temporary moratorium for 120 days on eviction filings on covered dwellings. Those include property financed by federally backed mortgage loans, and whether it's single family or multifamily, and covered by specified housing programs. There's some federal housing programs that are included in that. That's kind of a quick overview of those things. Obviously, we don't have time to go through this. We could spend an hour and a half or 2 hours just doing a summary of them, but I'm hitting just the highlights. And so the one highlight that I wanted to hit on the next slide, which would be slide 3, if you could advance that, Susan, has to do with section 4021. I wanted to focus on that because it deals with credit reporting, and the credit reporting issues right now are, I think, really, really important. The thrust of the legislation is to protect consumers' credit, and all of that goes to naught if you report the consumer, if you trash the consumer's credit report by incorrectly reporting information on loans that are in forbearance or otherwise affected by the COVID crisis. So this particular provision amends the Fair Credit Reporting Act to add special instructions for reporting consumer credit information to the agencies. And it has to do, and it's not just information that's arises out of financial difficulties due to the pandemic. There's just an assumption there that there are certain difficulties, and so they've gone ahead and amended the FCRA to deal with that. And the key provision there is if a creditor or other furnisher makes an accommodation to a consumer affected by the pandemic in connection with a credit obligation and the consumer satisfies the conditions, the furnisher has to report the credit obligation as current, or if the obligation was delinquent before the accommodation, then maintain that status. But if the consumer brings the account current during such period, including through by way of a forbearance, report the account as current. The key section here is the definition of accommodation, and I've included that definition because this is where I'm getting questions from clients. It includes an agreement to defer one or more payments, make a partial payment, forbear any delinquent amounts, modify a loan or contract, or any other assistance or relief granted to a consumer who is affected by a COVID-19 pandemic during the covered period. And I underline the words any other assistance or relief because a lot of the questions that I'm getting come from people who are interested in making the CARES Act forbearances and how to handle things during the interim time period between there's a request for the forbearance and the approval of the forbearance. And there's all kinds of provisions which we're not going to discuss today, but which many of you I'm sure are grappling with, having to do with how to handle requests for COVID-19 related forbearances and that sort of thing. If you give the borrower even a waiver of a late charge, I think that falls within the definition of accommodation. And there are no provisions for differentiating between different kinds of charges or different payment obligations. If you give an accommodation, you're required to report the consumer as current. And people also have questions about how this should be reported under the Metro 2 guidelines. Many of you are familiar with those, and there are guidelines out there for reporting payment delinquencies in light of natural disasters and that sort of thing. And we don't have time to get into all of those, but the statute is pretty clear, and it says you have to report them as current. So there don't want to be any shadow of a doubt. Some of those guidelines for natural disasters and natural disaster-related forbearances are supposedly treated in a neutral fashion by credit reporting agencies, but I'm not sure that applies to all the credit reporting agencies, and besides that, someone looking into it might have questions about that. So the safest course is simply to just talk about, just to report them as current. And then later, if there's an amend. And that covered period begins on January 31st. Yes.
I'm so sorry. There was a question. I believe you've answered it, but before you move on, I just want to make sure that we get to it. So the question is, so if a borrower invoked Section 4022, you can't consider that an early payment default. Is that correct?
That's a loaded question, and I personally think that is an argument that can be made in defense of a repurchase claim, on the grounds that even if there is no force majeure clause in the loan purchase agreement, there are common law principles known as impracticability, which you can find in the restatement and other case law on a state-by-state basis, that have to do with acts of God and that sort of thing. And one of the arguments that I've talked to clients about making is that in the defense of a repurchase demand, you can say that it's not an early payment default because under the provisions of the CARES Act, borrowers, if they are, all they have to do is state that they're impacted by COVID and they're entitled to a forbearance. And then there's also the moratorium on foreclosures. So the argument being that there is no default because of this, and therefore if there can be no default, or if their performance is excused, I guess is the better argument. If there's no default, then how could there be an early payment default? There's no case law on that. The statutes aren't clear, no regulatory pronouncements, but that is a really good question, and it's one that a lot of people are struggling with, and that's one of the arguments that can be made. So
thanks. I just wanted to make sure that we got that. I didn't want to interrupt you, but I can move on if you're ready for the next slide.
Yeah, let's move on to the next slide. That was a very good question, though, and I'm glad you interrupted. Slide 4, and I'm not going to go through all of these details, but what has happened is, in addition to the provisions of CARES, the CFPB has issued a supervisory statement on credit reporting, and those provisions in that supervisory statement are summarized here. And they're generally, with respect to that supervisory statement, there's sort of some broad sweeping generalizations. And I'm a little wary of them because they're just generally broad. They basically encourage furnishers to continue to furnish information despite the crisis. They expect the furnishers to comply with the CARES Act and will work with them to do so. They don't intend to take to cite in examinations or take enforcement actions against people who furnish the information that accurately reflects the payment relief measures they are employing, or who make good faith efforts to investigate disputes. The main benefit for our members of this supervisory guide has to do with investigating disputes, and the guide seems to recognize that in this current environment where there's a lot of pressure on servicers and on more lenders and servicers, in taking time to investigate credit disputes is going to be very difficult. So they're going to give a little bit of some time there. Beyond that, I'm not really excited about the benefits to the industry of this statement. There's another statement, which is the final slide on slide 5. Well, I guess it's a final topic, slide 5 and 6. Have to do with the joint statement that was issued on April 3rd regarding mortgage servicing rules and practices in response to the virus. And in that regard, there are a number of technical areas where all the regulatory agencies basically have said, look, we're not going to hammer you for certain things in connection with servicing mortgage loans that could conceivably be related to the COVID-19 emergency. And those include failing to provide an acknowledgement notice within the 5 days of receipt of an incomplete application. And that sort of dovetails with the forbearance provisions of the CARES Act, which of course we haven't discussed, but which allow people to grant temporary forbearances without a complete application. So they're giving you a little bit of a break here in not hassling you for failing to provide the acknowledgement on it within the 5 days of the receipt of an incomplete application. They also are willing to sort of overlook any delays in sending loss mitigation related notices and taking the actions described in Regulation X, which include a 5-day acknowledgement notice, a 30-day evaluation notice, an appeals notice, and that sort of thing. So they're sort of slackening some of the timeframes on these things that have been set forth in Regulation X. And that continues on the next slide, which is slide 6. And also, I've listed there the delays in establishing good faith efforts to establish live contact with delinquent borrowers, and delays in sending written early intervention notices. Those provisions tend to apply more directly to long-term modifications rather than temporary forbearances, but still nice to have that relief. And they are also finally willing to exercise some leniency with respect to delays in sending annual escrow statements required by Regulation X. Somebody asked me the other day, said, well, if they're going to be a little bit more lenient on that, can we just skip sending an annual escrow statement? And I don't think you can do that. I think you still have to send the annual escrow statements, but they're gonna be lenient with you on the delays. And with that, that's my report. There's a lot more in this. There's a lot more in the CARES Act, but if you go to slide 7, that's sort of the marketing piece right there. So that's my report, Susan.
Okay, well, thank you very much, Michael. We appreciate that, and managed to pull it off even in the with your technical difficulties. So thank you. We appreciate that. Now I'll turn it over to Carol Carson, who is our chair for the Mortgage Quality and Compliance webinar, and she can introduce our presenters today.
Well, thank you, Susan, and hello, everybody, and welcome to this month's webinar. It is my pleasure today to introduce you to our two main topic speakers. We have two terrific speakers today on our topic of cybersecurity and cyber insurance. We have Tom Delaney. Tom is the president of Bankers Insurance Services. I'm sure we all know that name. It is a provider of E&O, fidelity bond, cyber liability, and mortgage impairment insurance products, the top company in the U.S. Tom has been with Bankers Insurance for more than 25 years, where he rose up through the ranks of the company to become president now. He began his career as a loan officer at a small SNL, where he sort of honed his craft and became very well versed in all aspects of the mortgage loan life cycle. Welcome, Tom. Our other presenter is Mitch Tanenbaum. He is a leading cybersecurity expert. During his illustrious career, Mitch was one of the pioneers who brought the first GPS receiver for the U.S. Air Force into being. He was also a key leader at Texas Instruments Defense Systems, where he led a development of a variety of information systems. And for the last 20 years or more, Mitch has been in the mortgage technology business, including being a principal in the security software business, CyberCecurity LLC. Mitch has certifications under the Certified Information Systems Security Professionals and the International Association of Privacy Professionals. So with that, Mitch and Tom, take it away. We're interested in hearing what you have to say. Thank you.
Thanks, Carol. And Susan, you can turn me over to the presenter.
You are. You have it now.
I'm not seeing that.
If you click on the screen, it should work.
Yeah. There we go. Well, I'm not seeing any.
Go back.
Let me try this. There we go. Okay. So thank you, everybody. Thank you for the introduction, Carol. Thank you, everybody, for joining us today. I'm going to go through this relatively quickly so there's time if there's questions at the end. My email address here is at the bottom of the slide. Feel free to reach out to me if you have further questions. So when we're talking about cybersecurity, and especially right now in this time, it is a huge industry in terms of revenue for the cybercrime world. It's actually the third largest economy in the world, behind the U.S. and China. So it's a huge moneymaker for folks, and that's kind of why we're in the middle of all this, unfortunately. As everybody has moved to work from home. That's for some companies that's kind of like business as usual. It's no big deal. For a lot of companies, it's not business as usual. It's translated into bring your own device, which adds a whole other set of risks. And hackers understand that, and they're taking advantage. I saw an FBI report last night that said that a certain class of threat is up 1,600% since January. So, and that's specifically a certain kind of phishing attack. So, the hackers are definitely taking advantage of this, and people, your employees, are stressed out for a whole variety of different reasons. Companies in many cases are using new collaboration tools they haven't used before, which oftentimes means that security settings don't get thought out, and new processes are being used. We've seen this in the Zoom world, and I've written about this in my blog several times, but the vast majority of the Zoom problems are caused by human configuration errors. So the hackers don't care. They take advantage of it, whether it's something that you've done intentionally or something you've done unintentionally. Small businesses in particular, and obviously a lot of mortgage companies fit into that category, are not ready for remote working. They don't provide robust cybersecurity training, which actually is required by law in many states, and that causes users to do things completely unintentionally, but things that nonetheless put them at risk. We saw the Senate put out a memo, and a lot of companies have put out a memo. Zoom their usage has gone up by 2,000% since January. It's really pretty amazing that Zoom has managed to stay alive, given that. And they, in fairness, did do some things which, from a security standpoint, were not optimal, but they owned up to all of them, and they have worked very diligently to reduce those risks. Now we're seeing attacks against WebEx as well. So it's not Zoom in particular. It's just because their popularity went up by so much and their usage went up so much that they became an attack magnet. I don't know if this will go very far. We shall see. But Zoom is a target of a shareholder lawsuit over those security issues. I'm not sure that the shareholders are really going to have much of a long-term impact as a result of this, so we shall see. But the business email compromise attacks are definitely going up dramatically. We've seen this in the industry, and we get to respond to that with clients on a regular basis, where somebody gets into the middle of the food chain and redirects payments in one direction or another, and people wind up being out potentially a lot of money. I think the largest one that we've personally been involved in was about $300,000 from one transaction. So it's significant money, and it creates a lot of stress on the part of all the parties to the transaction. And this is one where user training becomes really critical. And now, in light of everything that's going on, user training really needs to be not only maintained, but probably stepped up so that people don't accidentally fall for things. And I will tell you that these guys, the attackers, are doing a really excellent job of creating bogus emails that look very, very realistic. Phone and phishing scams are going through the roof. The FBI said the other day that they've seen I forget what the number was, but tens of thousands of complaints that have actually been filed with them, and they're everything from supposed vaccines that obviously don't exist, since there is no vaccine, to cures which also don't exist, to all kinds of other things. So and the topic is click here for your COVID-19 related XYZ, or you get an unsolicited phone call, and then your computer gets infected. The smart attackers will do a low profile infection, meaning that once they get in there, they stay quiet. They kind of wander around, see what they can get to, and then later they launch the attack. So just because you don't see anything instantly when a user clicks on something doesn't mean that the computer is not infected. Here's one report that said that we've seen a 300% increase on attacks. We're just seeing a lot of it. Now, while that's happening, the privacy world is still going on. CCPA is still going on. States continue to consider what they're doing from a legislative standpoint. While some of the laws currently have either a partial or some cases even a full exemption for GLBA covered entities, the real question becomes, when is enforcement going to happen? And I don't pretend to be a lawyer. Well, sometimes I pretend to be a lawyer, but I'm not a lawyer and don't act as a lawyer and don't give legal advice. But I think in the short term, it seems highly unlikely that, except in egregious cases, that the Attorney General in California is going to go after folks. Now, I say that unless there's a breach. You have a big breach, I think all bets are off, and I think, and then it's feeding time. So no one really knows. The enforcement period for CCPA really doesn't start likely until July anyway. But I think everybody's watching this. So that's just more challenges on the part of businesses. I think the big story here is ransomware 2.0, and let me make a distinction between ransomware 1.0 and ransomware 2.0. Ransomware 2.0 is the kind of ransomware that steals your data before they encrypt it. The downside of ransomware 2.0 from a business perspective is the traditional defenses that you had for ransomware 1.0, which is good backups. You wipe out the computer and reinstall all the software and the data. That does not work in ransomware 2.0. And we're seeing people, paying multi-million-dollar ransoms because they say, gee, if you don't pay the ransom, we're just going to publish all your customers' data. That's a really scary thing. There's not a great defense strategy other than not making yourself a good target for attack for ransomware 2.0. There's just, all the backups and prevention measures you have don't help you if they've got your data. And we're seeing, I saw a number that said something to the tune of 80% of malicious attacks now are ransomware 2.0. And we're seeing the key word for one of the big ransomware 2.0 attacks is called the Maze ransomware, M-A-Z-E. And that's one that steals your data before it encrypts it. So that's a whole new line of defense that companies need to come up with for how do we go deal with ransomware 2.0. And typically these guys give you a very short time frame. I saw one attack yesterday where they did the attack, they posted the data, and they said, we're just kind of giving you a sample of what's out there, but we made this public. And if you don't pay us within 72 hours, we're going to make the rest of it public. So if you want us to take down the data that we've already published and not publish anymore, then you need to pay the ransom. That's a real challenge for businesses. The best defense there is keep the bad guys out. The next biggest thing is cloud misconfiguration, and as people move more and more stuff to the cloud, it's very easy to accidentally misconfigure stuff. The Capital One breach with 100 million records is a perfect example of that. And hackers are on the lookout. And we're seeing an interesting challenge here where researchers are reporting these exposed data sets on the internet, and companies are not doing a great job of responding to it. That's something where you've got to train people that if they get some kind of call or some kind of email from somebody claiming to be a good guy, their job is not to go off and try to figure it out. Their job is to go off and forward that call or email to the security team and let them figure it out. Because we've seen more than one case where the researchers said, nobody's responding, we'll just publish it. And now all of a sudden it's now out in the public and adds extra stress. Internet of Things, the best thing I can say, if I'm really being very kind, is the Internet of Things is a dumpster fire. And it's only going to get worse now that everybody is on home networks. This is kind of what you're looking at. It's your team against the risk, and it's a real challenge. I don't have a short-term answer. I have some long-term strategies for people, but in the short term, it's a real challenge, and know that that's just bringing extra risk to the equation. This gets a little technical, so I'm not going to spend a lot of time talking about this. But the gold standard now is that you want to be able to detect that you've been attacked in 1 minute. You want to be able to figure out what the attacker is doing in 10 minutes, and you want to be able to contain the attacker within 60 minutes. We actually have a client in California who's a California MBA member, as a matter of fact, that in a period of about a year was able to meet this gold standard. And it was very, very impressive what their team has done. And it didn't take a lot of money to go do that. It just requires that you apply some dedicated effort to it. The other half of that rule is patching. And we're seeing a lot more zero-day attacks. 0 days means attacks that were not known in the wild prior to them being exposed. And the 2472 rule says that you want to be able to patch a 0-day within 24 hours and patch other vulnerabilities within 72 hours, because hackers typically exploit, on average, these bugs. They weaponize these bugs in 7 days. Now, what we see industry-wide, 100 days is what people are taking. That gives the attackers a long time to get in there, burrow their way in there, and impact your network. Now, that's a real challenge. This month, between the top 6 vendors, which is like Microsoft and Oracle, and people like that, they released over 500 patches. So figuring out how to deploy that in any reasonable time frame is the challenge. But these 2 rules, the 11060 and 2472 rules, are the gold standard of where you want to get to try to keep the bad guys out and try to avoid being in the ransomware 2.0 situation. Supply chain attacks. I just spent 4 hours on a webinar this morning, starting at 6 o'clock in the morning, talking about supply chain attacks. It's a real problem. If they don't go after you, they're going to go after your supply chain. And we're seeing this in a number of the breaches, a number of the business email compromise attacks. I just was dealing with one earlier this week with a title company that got compromised. And of course the lender is trying to calm the borrower down. The borrower is out, in this case, $140,000. They did get made whole eventually, but it took some time. And supply chain is a real problem. And vendor risk management, really, while we've been doing vendor risk management from a compliance standpoint for a long time, that's mostly been licensing and things like that. Now we've got to go off and say, okay, let's go talk about your systems, your processes, and oh yeah, by the way, are you going to be able to make me whole when you screw up as a vendor and my client is impacted? So supply chain attacks are a real problem. Cyber risk insurance, it's a last resort, right? You don't want to count on cyber risk insurance as your defense, but you sure want to be in a situation where you've got that in your back pocket, so you're not writing a $250,000, $500,000 check to cover an incident. And Tom's going to talk a lot more about that, but that's all I have. That's my contact information. Feel free to reach out to me if you have more questions.
Great. Well, thank you. We appreciate that. We're going to now get the slides changed here and turn it over to Tom Delaney. The controls here. There you go.
Okay. Do I have it?
You should be ready to go.
Let's see.
You click on the slide once,
not...
it should connect you, and then you can advance them from there.
So I'm clicking and I'm using my arrows, but it's not advancing.
Did you use your mouse and click on the slide once?
Am I clicking on Mitch's slide?
I'm seeing my slides too. No, there we go.
There we go.
My apologies.
Just adjust this. There we go. All right, I have control. Thank you, Susan. Thanks, Mitch, for turning it over now that Mitch has got everybody significantly concerned and has kind of teed up the topic of cyber liability insurance. I'll try to help you understand a little bit what a cyber liability policy is intended to cover and the value you get from the purchase of such a policy. The genesis of cyber liability insurance was to protect businesses in situations where customer information, also known as personally identifiable information or PII, is breached, compromised, or leaked into the public domain. Cyber liability policies have broadened out quite a bit to cover more than that over time, and but we'll start off with brief discussion about PII and what it is. I'll just read this definition to you. It's from the U.S. Department of Commerce, defining PII as any information about an individual maintained by an agency, including 1, any information that can be used to distinguish or trace an individual's identity, such as name, social security number, date, and place of birth, mother's maiden name, or biometric records, and 2, any other information that is leaked or is linked or is linkable to an individual, such as medical, educational, financial, and employment information. So, here's some examples of PII. Things like full name, social security number, passport number, driver's license number, credit card numbers, email addresses, fingerprints, handwriting, biometric data. All these things are going to be considered PII. And if PII is leaked into the public domain, which can happen via a computer system or via breach or via actually a paper breach. So you could have a situation, actually, it doesn't even involve your computer, where a mortgage lender may not properly shred loan documents, and you can have a dumpster diver go through your dumpster and discover customer information, or your cleaning crew comes through at night and has a look at your paper documentation without even accessing your computer system. That still would be considered a breach of customer information. Should that happen, obviously mortgage lenders are going to pick up not only liability to those affected consumers, but other costs in dealing with the breach. Obviously, some industries don't collect much PII, but certainly financial institutions and mortgage lenders collect a lot of it, given the amount of information that, of course, is in a loan file. So if a data security breach occurs at your firm and PII is leaked into the public domain, you'll pick up 3 main exposures, the first of which is liability to impacted clients in the form of litigation. So obviously your consumers would be upset with you that their information had been breached, and lawsuits may result from that breach. Secondly, you'll pick up unanticipated, or I guess anticipated, costs. You may need to offer things like credit monitoring to your clients. You could experience a business interruption, so you'll have loss of income and additional expense in dealing with frozen or stolen data. Obviously you'll have to spend money to recover lost data, and as Mitch talked about, you have the cyber extortion or the ransomware payments that would be additional costs that your firm could incur in the event of a breach. And then this slide talks about notification of your clients. So in all 50 states, there's been legislation enacted requiring private or governmental entities to notify individuals of security breaches. And these notification requirements are based on the location of the consumer and not the location of the business. And it's very much a patchwork of state laws that need to be complied with. So if you're lending in multiple states and you do have a data breach, it can be very, very challenging to keep track of the breach notification laws and respond to those and perform appropriately. So long story short, data breaches can be expensive and very time consuming to address. In terms of the cyber liability policy itself, and now that we've discussed PII, let's take a look at what the insurance policy does and how it can protect mortgage lenders from these losses. In terms of cyber liability insurance, or data breach protection, as it's sometimes called, the policies have 4 main components, and those are the breach response services, which we're going to discuss on this slide. But then there are also first-party coverages, third-party coverages, and then some additional features that we'll talk about on the next 3 slides. But should you have a breach, policies will either, 1, reimburse your costs of notifying your clients that you've had a breach, or certain insurance companies will do the notification on your behalf, likely with the assistance of a third-party cybersecurity firm or a law firm. In my opinion, I think the latter is the better way to go, because these firms are insurance companies. They're experts in knowing how to notify and meet all of the state regulations. Might as well let them be the experts and do it for you versus trying to go it on your own. And you use your own resources to respond to the various state breach notification laws, and then look for reimbursement from the policy. You might as well have an expert do it on your behalf. A lot of policies also pay for credit monitoring. So if you do have a breach and you're going to or need to offer credit monitoring to your clients, the policy will pay for that. Breach response services within the policy also cover the cost of things like computer forensic services, legal services, call center services, crisis management, and public relations if you have to hire one of those firms to kind of limit your exposure and limit your losses. This coverage, breach response services, typically are offered as an aggregate monetary limit of coverage, or it can be offered on the basis of a certain number of notified individuals or notified customers. And it's important that you get a policy that separates out the limit for the breach response services. So any sort of litigation or lawsuits or third-party exposure or third-party claims that get paid don't erode your limit that you have for your breach response services. It's essential that this service is all-inclusive and provided by a reputable group. It's good. So most insurance carriers who are going to do these breach responses on your behalf have partnered with third-party cybersecurity firms and vendors to perform, some of the public relations activities, crisis management, the breach notification itself. So it's important that when you sign up for a policy that you get a list of who these vendors are ahead of time. Pick the ones that you want to work with, sign any contracts that need to be signed with them ahead of time, and really kind of treat a cyber event almost like a fire drill where you've practiced and you know what you're going to do if you do experience a breach, and you have all of these vendors set up and ready to go so that you're a phone call away and not trying to figure it out at the last minute. Be prepared for, I guess not if, but when it does happen. In terms of the breach response services, I think this is probably the most important part of the policy. So and again, this is genesis of why the policies came to be in the first place. But this is where you really get the expertise of the insurance company and any firms that they have partnered with. In terms of the first party coverages, this is the second part of the policy. 1, 2, 3, 4, 5 main components of the first party coverages. First is going to be your business interruption coverage. This is primarily covering loss of income that you experience if your business is interrupted by a breach, and additional expenses that you might pick up in the event of a breach. The trigger under this part of the policy can either be a system failure without a hack, or if you actually have a hack itself. So it's good to know that a system failure actually can trigger this part of the policy. It absolutely can be the result of a ransomware event that Mitch talked about is very much a emerging exposure. And then the next part here is dependent business loss. So this is going to give you similar type coverage, but this is going to be a loss that's caused by someone else's breach or somebody else's system failure. It could be a cloud provider or some other vendor that you've partnered with. So this is your dependent business loss coverage. Then you have data recovery costs, which are going to cover your cost to regain, access, or replace compromised data. Cyber extortion, also known as ransomware, which is again the kind of the crime of the day. This part of the policy actually will pay the ransom and also pay the expenses to respond to the threat. And some examples might need to hire a forensics firm to help you deal with a ransomware event. Maybe a negotiator has to be provided to negotiate with the cyber criminals. That would be an expense you would pick up that part of the policy would cover. Also, if there's Bitcoin that needs to be secured to pay the ransom, there could be some process and some expense involved there. So obviously a very, very popular and frequently hit part of cyber liability policies in today's world. And then we have social engineering as the final first-party coverage, very popular. We've seen this for, 3, 4, 5 years now, where we've all heard of these situations where somebody within a mortgage firm's accounting unit gets an email from the CEO instructing them to forward funds for the purpose of completing some transaction or some piece of business. And so acting on that email, funds are wired to an account that actually is a criminal's account. And it turns out that the email from the CEO was a fake email altogether. And so you get some coverage under the cyber liability policy for that type of loss. It's oftentimes sublimited. It's rare that we see the full limit of the policy provided for that coverage. It's our experience, actually, you can find a little bit of this coverage under your fidelity bond as well. So a couple different places where you might look for this type of coverage for social engineering. And let's see, go down. Oops, I've lost control. Oh, there it went. Okay. Third party coverages. It's a third part of a cyber liability policy. Basically, your data and network liability coverage is the part of the policy that's going to defend you and pay the damages if you get sued as the result of a data breach. So these are usually going to be customer-driven suits. They can come in the form of individual suits brought against the insured or class action suits if a group of affected customers bring the suit against the insured. Again, this is going to defend you and pay the damages if you have to settle, or if there's some judgment that comes down that's rendered against the insured. This part of the policy also pays the damages. Also coverage for regulatory defense and penalties. It's going to pay claims expense, and the penalties themselves, where insurable. Certain states don't allow penalties to be insured, but where they are insurable, it'll pay those penalties resulting from civil investigations brought by any federal, state, local, or foreign governmental entity. Again, paying the defense costs and the penalties, and this is where you have some protection in the event of a violation of one of the federal or state consumer protection laws. New York and California having a couple of the more onerous laws in this space. Also coverage for multimedia, website media, and social media content liability. Again, going to pay the damages and the claims expense resulting from a claim for things like defamation, libel, slander, plagiarism, piracy, misappropriation of ideas, infringement of copyright as a result of media that's on the company's website or social media sites. So that's an interesting coverage that I'm not sure a lot of people realize exists in their cyber liability policy. And then if you're a business that transacts with credit cards, there's some coverage for PCI fines, expenses, and costs under the third-party coverages. In my view, the top two are the main coverages, the data network liability and the regulatory defense and penalties. Finally, some additional features that you find in the cyber liability policy. Full prior acts coverage is something that's very important to keep an eye out for. When we underwrite on behalf of certain syndicates at Lloyd's of London. And so when we first put our cyber liability program together in Lloyd's, we did not offer coverages with full prior acts. We didn't offer policies with full prior acts. And what that means is, in order to have coverage under the policy, the breach itself has to have been initiated after the inception date of the insurance policy. So if there was a breach ongoing and you didn't know about it, and then you bound coverage and then later discovered it, there's a good chance that loss would get kicked out because there was no prior acts coverage. Very, very popular in today's market for insurance companies to offer this coverage with full prior acts coverage. So as long as you don't know about a breach that's going on at the time that you incept the policy, and then you discover it during the policy period and report it to the insurance company, it now would be covered because of this full prior acts feature. Some additional features also include pre-breach risk management as well as some post-breach services. The pre-breach risk management services basically are services that the insurance company is going to provide to you to prevent you from having a loss in the first place. So they'll provide things like educational content, tip sheets, webinars, training materials, best practices, email alerts of recent cyber trends, and a breach response guide to kind of walk you through what to do in the event you do have a breach. I mean, obviously the insurance company wants to prevent a loss in the first place, right? And I think not enough people realize that these services are available and don't take advantage of them, but it can be a good guide for you to follow and so as to avoid a claim in the first place. And then there are post-breach services, which provide cyber autopsies after breach to help identify vulnerabilities and critical gaps in your security program and get you back to business. Small feature is criminal reward. If you somehow assist in the conviction of individuals who commit the illegal acts, the certain insurance policies will kick $25,000 or some minimal amount over to you for your help in convicting the criminal. Again, my opinion, more people should take advantage of the pre-breach risk management services, and it's something to look for when you buy your cyber liability insurance policy. Now, finally, just what we're seeing in the marketplace. Here's kind of some indications of some premiums that, you know, for smaller limits of cyber liability insurance. You can have a look at that. According to an Aon company 2019 Global Risk Management Survey, since 2015, the cyber insurance marketplace has more than doubled from $1.5 billion to $4.5 billion of premium. So it's really, really become a sexy product. Obviously, 75% of banks purchase cyber liability insurance, which surprises me that that's not 100%. 65% of real estate firms purchase cyber liability. So since we've had our binding authority in place since 2012 with Lloyd's, really all that we've seen in this segment is rates going down and down and down as more insurance companies want to get into this line of coverage. Also, a response to that competitive environment is coverage getting broader and broader and broader. And this is in a massively developing claims environment. So I think anytime you see rates getting driven down, coverage getting widened out in an expanding claims environment, you're going to see a correction happening, and we're starting to see some signs of that already. According to a recent Reuters article, cyber liability rates are up 5 to 25%, kind of depending on what industry you're in. Healthcare and financial institutions probably getting a little more rate than some other industries, but there definitely is a correction going on in this marketplace. And then specific to ransomware trends, we're starting to see carriers maybe sublimit that ransomware coverage so you don't get the full policy limit for ransomware events. Also attempts to impose co-insurance provisions where the insured actually has to pay 20 to 30% of the ransom, and the insurance company will pay the other 70 to 80% of the ransom, just to kind of limit the losses the insurance companies are experiencing for these types of events. We also see a little stricter underwriting going into play, where insurance companies are asking what systems are in place to defend against ransomware attacks, and having supplemental or separate applications to drill down into what protections are in place to prevent the ransomware attacks. So a little closer, more stringent underwriting going on. And there's actually a little bit of conversation going on about carving the cover out altogether from the cyber liability policy and having it be its own standalone product, so that insurers can better isolate that exposure, underwrite to it, and price for it instead of blending it in with the rest of the policy. But I haven't seen that yet, but that's something that we could see coming about in the marketplace. So this is just a little information about some trends and developments in the cyber liability space. So hopefully that helps you understand what's in the policy, how it's structured, what's covered, what additional features you get with cyber liability insurance, and it's very, very valuable. It's something you should. A mortgage lender has a ton of PII, it has a ton of exposure, and I think it's something to be looked for. So I guess with that, I'll turn it back to you, Susan.
Okay, well, great. Thank you, Tom. I really appreciate the information from both you and Mitch. We planned these topics out at the beginning of the year, and little did we know that we would have chosen a topic for April of 2020 that could be this relevant to what we're all dealing with right now. I know even in our small environment at the California MBA, we've seen, as Mitch was articulating during his presentation, just this dramatic increase in phishing emails and scam emails just in our tiny operation. So I can imagine that, much larger organizations are really having to take a closer look at those at those aspects and kind of what's coming into their team members, especially as we're all kind of working from home. So if you have a question for either of our presenters, you can type that in the dialog box. We do have one to start us off. Is there, and this would I assume this would be for Tom, is there a formula that a company should employ to determine how much cyber liability insurance coverage to purchase? So is it like, 3 times your gross revenue, for example, or is there a simple method? Or
I mean, unfortunately, it's not as simple as meeting the Fannie Freddie requirements for Fidelity Bond and E&O insurance, where they actually have a formula in their guide that tells you how much coverage you need. For our program, we've talked about breach notification, and our breach notification doesn't offer a limit of insurance. We do it on a number of notified individuals basis. So a good starting point would be just to have a look at the records that you're maintaining, and if you had a breach, how many of those records would potentially be impacted. And that would govern how much breach response you want to buy by a number of notified individuals basis. And then you can take a look at, the liability limits for the other parts of the policy, be they third party, first party, kind of separately, and decide, is it $1 million? Is it $2 million? I do have some stats not in this slide that show the average cost of a breach, and certainly happy to have a conversation with somebody to kind of do the math behind, here's the average cost of a breach, here's how many records you have, multiply those together, this is what your limit exposure could be. So it's a little less scientific, it's a little more art, but that's kind of how I would go about it.
Okay. All right. Well, thank you. I appreciate that. Any other questions for our presenters? Please, you're invited to type those into the questions dialog box.
One quick comment, Susan.
Certainly.
We're seeing states reduce the amount of time that businesses have to notify people, whether it's notifying the people who are affected or notifying the Attorney General or whoever, and that makes things much more difficult. We just dealt with a breach just recently. Colorado has a 30-day notice with no extensions, and the first thing you have to do is figure out who is affected. Then you have to figure out what states they live in. Then if you have loans that closed a while ago, you need to figure out where they live now as opposed to where they lived when they closed the loan, and then you have to generate the notice. And it's in Colorado, every state's different, but in Colorado it's 30 days from when you detect the breach. So that's a very short period of time, and as Tom said, you really want to have all those services in place so that you're not, trying to read contracts and trying to figure out who you're going to be using for these services. And even if you're using your insurance carrier and they have preferred vendors, you still want to pick who you're going to use out of the preferred vendors. 30 days or 45 days, 60 days is not a very long period of time. Right.
And I think that, as we always say when we're talking about, cybersecurity, it's not if it will happen, it's when. So good advice to kind of be as prepared as you can going forward. Well, that wraps up today's webinar, and thank you, Mitch and Tom, for some great content and a very timely topic as well. One message before I end today's webinar: our next webinar will be on May 28th, and we're going to be looking at some areas of fraud that the GSEs are seeing and the areas that are prevalent to them. We have some great speakers from both Fannie Mae and Freddie Mac that are going to be joining us. So mark your calendar for May 28th, and please be sure to join us for that webinar. That concludes today's event. Thank you so much for joining us, and we'll see you next month.